Welcome back, everyone. Today we're diving deep into Interactive Brokers' Q3 2025 earnings, a quarter that marked record revenues, impressive profit margins, and continued client growth. Whether you're an investor, trader, or finance enthusiast, this analysis will give you a crisp, clear picture of how IBKR is performing, navigating challenges, and shaping its future. Stay tuned as we break down the numbers, management commentary, growth drivers, challenges, and valuation outlook. Okay, let's jump right into the big picture then, because, wow, the headline here is pretty staggering. We're talking Interactive Brokers, the brokerage that's proudly debt-free, and they're showing this level of operational efficiency that, well, it doesn't just match its peers, it actually crushes them.
Yeah, it really does.
And the number we absolutely have to start with is that profit margin. IBKR logged an astonishing 79% pre-tax profit margin this quarter.
79%. I mean, you just don't see that sustained really outside of maybe high-end software firms with almost zero marginal cost.
Right.
In traditional finance, brokerage especially, that figure, it's defining. It really does turn the company into a kind of financial fortress.
Exactly. So let's unpack that 79%. Is this just like a flash in the pan? A peak maybe driven by the current high rates? Or does it signal something more fundamental, a sustainable edge?
Well, it's probably a bit of both, but I lean towards the fundamental advantage. That margin, you see, it's the bedrock of their entire competitive strategy.
How so?
Because their costs are so incredibly low and largely fixed, they can afford to be really aggressive competing on price, on interest rates, globally, and still keep profitability that others just can't touch. That efficiency is directly fueling their sort of global land grab for these new high-value customers.
And it looks like that land grab is definitely working. They reported record revenues and officially blew past that 4 million customer account milestone.
Yep.
But look at the capital inflow. Client equity surged 40% year over year. It's now at $757.5 billion.
And that is the real measure of quality, I think. Consider this. The S&P 500, the benchmark for the market's health overall, climbed at maybe 16% over that same time.
Right.
IBKR's client assets, they're accelerating at 2.5 times the rate of the broad market. That tells you something important.
What's that?
It tells you they're either attracting much wealthier clients or maybe existing clients are just consolidating huge amounts of capital onto the platform. They're trusting IBKR as their main financial hub.
And it's not like they're sitting still on innovation either, which probably helps build that trust. They briefly mentioned some key tech drivers, notably that new AI-powered portfolio insight tool, Ask IBKR.
Yes, Ask IBKR.
We also saw this massive surge in crypto trading volume, up something like 87% quarter over quarter, and that seems to link directly to their plans around stablecoin funding and asset transfers.
Correct. The whole story with IBKR seems to be this. High efficiency, that 79% margin, generates the cash flow they need to invest heavily in tech.
Which then attracts and keeps clients globally.
Exactly. And that justifies the premium valuation we see in the market.
Okay, so we've established the margin is huge. Let's get a bit more mechanical and break down the engine that actually produced it. Looking at the Q3 financials, GAAP net revenue was $1.655 billion. That's a solid 21% jump year over year.
Right. And adjusted revenue came in at $1.610 billion.
And the GAAP diluted EPS was $0.59, which, well, that was a pretty wide beat against what the market expected.
Yeah, that EPS beat is tied directly to their operational muscle, no doubt. But the biggest story here really is net interest income, NII.
Yeah.
For IBKR, NII isn't just a source of revenue. It's like the gravity well pulling in profits. It hit a quarterly record, $967 million, also up a strong 21% year over year.
Almost $1 billion in NII in one quarter. That's
phenomenal.
But how did they actually engineer that? What are the specific mechanics driving it?
It's kind of a dual dynamic, really. It relies on both what clients are doing and the market infrastructure itself. So the first driver is simple: higher balances. Customers are just putting more money into the term, right? Which IBKR can then earn interest on.
Makes sense.
We saw customer margin loans up 39% to $77.3 billion. Yeah. And customer credit balances, they were up 33% to $154.8 billion. So they're earning interest on bigger and bigger pools of, well, your capital.
And the second driver, the one you said is often overlooked.
That's securities lending. This was the real dark horse that kicked NII into high gear this quarter. Net revenue from their securities lending segment actually doubled.
Doubled?
Yep, doubled. Reached $314 million, up from just $156 million in the same quarter last year.
Okay, maybe quickly for listeners who aren't super familiar with that, what exactly is securities lending and why is that doubling so significant?
Sure. So basically, when you hold stocks or bonds at IBKR, they can take those holdings and lend them out to others. Often short sellers need to borrow them. They charge a fee for that.
And they split the fee.
They split the fee with you, yes, but they take a good chunk themselves. That revenue doubling. It means their highly automated system for matching borrowers and lenders of securities is just running at peak efficiency. They're squeezing maximum value from every asset their customers hold.
Which brings us back to cost control and the magic behind that 79% margin. It wasn't just revenue growth, right? It was also cutting costs.
Yeah.
We saw a 21% drop in execution, clearing, and distribution fees.
Yes. And two things really stand out there. First, the cost reduction got a bit of help from a regulatory change that directly boosted their margin. The full quarter effect of that SEC Section 31 fee rate going down to zero back in May 2025.
Ah, right.
That one change alone. Estimated savings of over $20 million for the quarter.
Okay, let me just clarify that for you, the listener. That SEC fee wasn't really a cost for IBKR. It was a fee they collected and just passed on to the government.
Exactly.
So when that fee went to zero, IBKR still ended up paying less overall to third parties for execution because that specific pass-through expense just vanished. Instant margin boost, tens of millions.
Precisely. And the second factor is internal optimization. It's their smart order routing.
SER.
Think of SER like this really sophisticated search engine. It's constantly hunting for the absolute best price and the best place to execute every single client trade.
Okay.
By optimizing this constantly, they capture higher liquidity rebates, which are basically kickbacks for sending trades to certain exchanges. That drives down their own execution costs dramatically.
And we should probably mention, while the general and administrative expenses, G&A, were down 59%, saving them $88 million.
That was mostly a one-off, yeah. Cleaning up from a legal thing from the prior year.
Right. So the real story is the underlying operational genius in execution and managing those fees.
Absolutely. They're showing that even without those one-time gains, their core model is just built for maximizing margin.
And that robust financial position, it seems to be feeding their client acquisition machine, which looks like it's accelerating. Let's look at that growth velocity. There are now over 4.13 million accounts, right? Up 32% year over year.
Yeah, and the speed here is what's really key. They added 790,000 net new accounts just through Q3.
Just in the first 3 quarters.
Right. That number already beats the total net new accounts they added in all of last year.
Wow.
This isn't just steady growth anymore. The momentum is accelerating dramatically. It almost looks parabolic.
That acceleration kind of leads to what I see as the real aha moment on client equity. The capital inflow is stunning, and management pointed this out themselves. It took them 4 years, roughly 2020 to 2024, to get from $250 billion to $500 billion in client equity.
Right, 4 years for that first $250 billion jump.
But then it took them just over 1 year to add the next $250 billion, hitting that $757.5 billion figure we mentioned.
That velocity, it tells you they're increasingly capturing a flight to quality. It's not just small retail accounts anymore, you know.
Definitely not.
They're pulling in high net worth folks, RIAs, professional traders,
Yeah.
people bringing large amounts of capital and, crucially, high activity levels with them.
So are these high-value clients actually trading? Let's break down those volumes. Total DART's daily average revenue trades were up 34% to 3.62 million.
Which pushed commission revenue to a record $537 million, up 23%.
So what were the trading winners? Where was the action?
Customer stock share volume was the clear standout. It soared 67% year over year. Huge jump.
Okay.
Options volume also hit a new quarterly record,
Right.
up 27% year over year. So this indicates a really high level of market engagement by their clients. It suggests they're attracting those active, sophisticated users.
Was there any soft spot in the trading activity, anywhere things looked a bit weaker?
Futures trading volume was the, let's say, minor weak spot. It showed a noticeable dip, 19% down quarter over quarter and 7% year over year.
What does that suggest?
It probably suggests a slight pullback in institutional hedging or maybe speculative futures activity compared to the last few quarters. But overall, the firm is clearly succeeding in attracting and keeping these high-quality, capital-rich traders.
And part of that retention strategy has to be offering those highly competitive interest rates, right? Currently, 3.59% on qualified U.S. dollar cash balances.
Absolutely. That rate is a major draw.
But that competitive rate isn't the only hook, is it? It's the tool set they offer on top of that rate that probably justifies people moving massive pools of capital over.
Right.
So let's talk about that technology push that really defines their competitive moat. Starting with that AI assistant, Ask IBKR.
Yeah, Ask IBKR is pretty powerful. It's like democratizing sophisticated analysis. It lets you use natural language, just like talking to a smart assistant,
Right.
to instantly analyze really complex portfolio questions.
So instead of me spending an hour digging through performance reports and sector breakdowns, I could just ask, what sector am I underweight compared to the S&P 500?
Exactly. Or show me all my unrealized tax gains from last year.
It just lowers the barrier to getting that professional grade analysis instantly.
Precisely. And the other platform innovation is connections. This is vital, I think, for making the platform sticky.
Sticky how?
Connections is basically an investment discovery tool. It proactively finds related trading opportunities for you across global markets.
Okay, how does that actually work? Can you give an example?
Sure. Let's say you're researching a specific home builder stock in the U.S.
Okay.
Connections might instantly link you to related mortgage financing stocks, maybe over in Europe, or housing market economic indicators coming out of Asia, and perhaps even show you a specialized option strategy you could use to hedge your exposure to the construction sector globally.
Ah, I see. So it keeps you exploring within their ecosystem.
It ensures that once you're on the IBKR platform, you basically have no reason to leave to find your next idea or related hedge.
That interconnectedness sounds key. And speaking of sticky platforms, let's revisit that digital assets roadmap, especially given that huge 87% quarter-over-quarter crypto volume surge.
They have a very clear phased plan here. It seems dedicated to removing the common friction points for crypto investors.
Like what?
Well, the first step is stablecoin funding. That's expected by the end of October 2025. Makes funding an account faster, maybe cheaper.
Okay.
But the critical feature, the one everyone's watching, is crypto asset transfers. That's planned by the end of the year.
Why are asset transfers so critical? What's the big deal there?
Because it removes a major competitive barrier right now. If a high-value client holds Bitcoin or Ether on, say, Coinbase or another platform, they can't easily move it into IBKR today. Once transfers are enabled, clients can consolidate everything: stocks, futures, cash, and crypto, all into that one highly efficient IBKR umbrella.
Which just drives that $757.5 billion client equity figure even higher.
You got it. And looking further out, they're planning staking services for early 2026. That creates yet another passive yield stream for clients holding crypto.
It seems like a pretty measured, conservative approach to a high-growth but sometimes volatile sector.
Which naturally brings us around to the question of valuation. I mean, given all this operational excellence, why is the market willing to pay such a high premium?
Yeah, currently IBKR trades at a PE ratio of about $33, 2 times dollars. That's significantly higher than the peer average, which usually hangs around 25 times dollar.
Right.
But as we've discussed, that 79% margin, the debt-free balance sheet, a strong 17.6% return on equity, that arguably justifies the premium. Analyst consensus even suggests it might be moderately undervalued by maybe 12–15% compared to a fair value somewhere near $75.09.
Okay, so the premium seems earned, but it does highlight the company's single biggest, most quantifiable risk. Its Achilles heel, if you will.
Which is?
Its sensitivity to interest rate cuts. Specifically, net interest income sensitivity. We know NII is their main engine, right?
Right, the $967 million engine.
But it's heavily dependent on the Federal Reserve and benchmark rates.
And we are already seeing some pressure there, aren't we? The net interest margin, NIM, it compressed slightly year over year, moving from 2.37% down to 2.16%.
Yeah, a slight compression. And management gave us the crucial figure to watch. Just a 25 basis point cut that's only 0.25% in U.S. benchmark rates. That would reduce their annual NII by a very significant $77 million.
Wow, $77 million for just a quarter-point cut.
It's a powerful warning sign. If the Fed pivots quickly, aggressively, into an easing cycle, that $77 million comes right off the top line for every quarter-point cut. That directly challenges the sustainability of that incredible 79% margin.
We should probably briefly note other risks, too, like the decline in fees they get from high-risk exposures, which were down $12 million, and volatility and currency diversification actually reduced comprehensive earnings by about $33 million this quarter.
Minor points compared to the NII risk, but still worth noting.
Okay, so let's finish by maybe outlining the 3 main scenarios analysts seem to be using to model the future here.
All right, so in the base case, let's assume the PE kind of moderates a bit, maybe to 31 times earnings. This scenario assumes EPS growth slows down to maybe 6 to 8% a year.
Okay.
In line with stable but gradually falling interest rates. Under that path, the target price seems to fall somewhere between, say, $73 and $75.
Then there's the exciting bull case. PE expands to maybe 37 or 38 times.
Yeah, the optimistic view.
This relies heavily on continued exceptional organic growth, keeping up that 30% plus account acceleration we saw. It also needs successful execution of that crypto roadmap, especially the asset transfers. And NII needs to remain relatively stable. Perhaps rates don't fall too fast. That trajectory pushes the target way up, maybe $92 to $95.
And finally, you have the bear case. The PE drops back down closer to the peer average, maybe 25 or 26 times.
What triggers that?
This scenario gets triggered by a nasty combination. A sharp, sudden drop in benchmark interest rates, let's say more than 100 basis points, a full percent or more.
Okay.
Couple that with a severe decline in market volatility, which crushes trading volumes, maybe down 15, 20%. That kind of double whammy. It suggests a price target much lower, maybe between $50 to $54.
So pulling it all together, synthesizing everything we've covered, IBKR really looks like the definitive, high-quality, high-margin player in the space. Yeah. They're using that incredible efficiency almost like a weapon.
I think that's right. And the technological advantages we talked about, Ask IBKR Connections, the crypto roadmap, they help prove that the 79% margin isn't just a temporary benefit from high interest rates.
It might be sustainable.
It seems more sustainable because they use that massive profitability to just accelerate their capture of those high-value global client assets. It makes them potentially a true premium compounder, assuming, of course, they successfully navigate that inevitable interest rate risk down the road.
What drives your conviction? Is it the 79% margin, the $757 billion in client equity, or the AI innovation? Let us know in the comments below. Don't forget to like this video and subscribe for more deep dive analysis. And just a reminder, folks,
we are not certified financial advisors, and this content is really just for educational purposes.
Yeah, so if you are considering making any investment decisions, please be sure to consult with a certified financial advisor.